Welcome to LR Reports. This episode is based on institutional research published by a leading global financial firm. We focus on the core investment thesis, key assumptions, and material risks outlined in the original report.
Welcome to the Deep Dive. You're joining us for an analytical deep dive into a crucial piece of institutional strategy, really designed to give you that strategic overview for the year ahead. And for this deep dive, our singular source document is from Bank of America Global Research. It's their U.S. Equity Strategy Report titled 2026 Year Ahead, All Bulled Up, which was published on December 9th, 2025.
That title, All Bulled Up. It just captures BofA's central question perfectly. They're asking if the market consensus, after such a strong run, has become just too optimistic. Their theme is explicitly cautionary, all bulled up, and no place to go.
It really signals that potential mismatch between what everyone's hoping for and what's actually realistic.
Exactly.
And yet, despite that caution, the report does deliver a very concrete and positive target for the S&P 500. They're calling for 7,100 by year-end 2026.
And that 7,100 target is really the core of this whole internal conflict in the report. On one hand, it implies a pretty modest return, right? Only about 5% price return from current levels.
Okay, so strong fundamentals are there, but the returns are modest. What's the constraint? What's holding it back?
It all comes down to valuation and market psychology. They expect that strong fundamental growth to be, severely constrained by an anticipated 10-point PE multiple contraction.
A 10-point contraction. So just to be clear for everyone, that means for every dollar of earnings a company makes, the market will be willing to pay $10 less for it than it did last year.
That's it. It's a huge derating, and it suggests both believes rates, inflation, or just general risk aversion is going to put a serious cap on what investors are willing to pay.
And they don't just give the target. They also frame this with a really wide range of possible outcomes, don't they?
Oh, absolutely. The range is massive. Their bear case, which is tied to a full-blown recession, sits at 5,500. That's about a 20% drop.
The typical bear market.
Right. And then on the flip side, the bull case, which assumes we get these huge earnings beats that keep the multiples high, that goes all the way up to 8,500. So about 25% upside. That 7,100 target is really just the prudent middle ground.
So if BofA is worried about the market being all bulled up, let's start right there. Let's look at market psychology and positioning. How does the current investor stance actually support that skepticism?
Well, the interesting thing is the initial data is maybe a bit less euphoric than that title might suggest. You look at their sell-side indicator, which tracks how strategists are allocating to stocks, and it's in neutral territory.
At what level?
At a 56% stock allocation. So it suggests that the optimism is contained. We're not yet in that phase of widespread euphoric buying that usually marks a big market top.
But the report does add a note of caution there, that neutral reading isn't necessarily a comfort.
Correct. While it's not euphoric, that 56% level is a lot closer to the historical sell threshold than it is to the buy threshold.
So the tactical dry powder on the sidelines is getting low.
That's the implication. It's a mild caution signal. It suggests that while the consensus hasn't totally peaked, the market is already highly invested.
Okay, let's shift gears to liquidity. BofA flags this as a major potential headwind for 2026. They say liquidity is strong now, but the direction of travel is what matters, and that's toward less accommodation.
Yes, and they see three primary forces all working together here. First, just the pace of monetary easing. It's expected to slow down dramatically.
Dramatically.
Well, global central bank rate cuts are forecast to nearly halve. They drop from 139 in 2025 to just 78 in 2026. That's a huge reduction in systemic liquidity.
And the other two factors, I assume, are fiscal policy and corporate actions.
Precisely. The second is government stimulus, which is expected to recede. U.S. debt to GDP ratios are at these uncomfortable new highs, which makes big stimulus packages much harder to push through.
Less government money in the system.
Right. And third, you have corporate share buybacks. They were a massive driver of demand, hit all-time highs in 2025, but they're likely to be constrained going forward.
Constrained by what?
Two things, really. Increased capital expenditure, which just soaks up cash, and then rising debt levels that force companies to start deleveraging instead of buying back stock.
And BofA also flagged a more nuanced risk, This one tied to individual investors, who were, what, 40% of small cap volumes last year?
Yeah, this is a fascinating point. The report suggests that the huge capital gains a lot of these retail investors made in 2025 could lead to some unexpectedly large tax bills in early 2026.
So that tax payment could drain capital that would have otherwise been used for dip buying.
Exactly. It removes a really key immediate source of marginal liquidity that has been propping up the market since the pandemic. So if psychology is contained and liquidity is getting tighter, let's pivot to the structural numbers. How do those strong earnings you mentioned square with the valuation picture?
This is where the tension becomes really, really acute. The valuation signal is basically flashing bright red. On the metrics BofA tracks, the S&P 500 is statistically expensive on 19 out of 20 of them.
19 out of 20.
And here's the kicker. It's trading above the March 2000 tech bubble levels on 9 of those, including things like market cap to GDP. That sounds, frankly, dire.
It does. It sounds alarming. But BofA does provide some really important nuance here that stops it from being just a panic call. They argue this is partially justified.
Justified how?
The composition of the index has changed. It's shifted toward higher quality, more asset-light companies. Think software, platform businesses. They just naturally command higher multiples. And crucially, there's much lower leverage across the index today compared to past cycles.
So expensive, yes, but the quality is higher.
The fundamentals underpinning the expensive names are just stronger than they were in 2000.
And that tension, high price, high quality, it's reflected right in how they built their 7100 target. I found it interesting that the target is a weighted average, and the most bearish input is actually their own fair value model.
Exactly. That fair value model, which is their most conservative, historically based model, spits out a target of just 5,940. It really shows how far we've stretched beyond historical norms.
And that's based on inputs like a 2.5% real risk-free rate and what they call a 225 basis point equity risk premium. Can you just unpack that ERP for us? Why does that number matter so much?
Of course. The equity risk premium, or ERP, is just the extra return investors demand to take the risk of owning stocks over holding a risk-free government bond.
Okay.
So when BofA sets that premium at 225 basis points, or 2.25%, they're building a pretty significant degree of caution into their model. It essentially discounts future earnings more heavily to account for risks like higher rates. And that's what pulls that fair value target down so much.
So the only thing pulling the overall target up from that bearish 5,940 to 7,100 is the earnings outlook.
That's the entire story. The fundamentals are the ballast. BofA is projecting that very compelling 14% EPS growth for 2026, getting to that $310 number. That growth is the only thing offsetting the expected PE squeeze.
And the macro thesis behind that growth is a really powerful one. A shift away from consumer consumption, the C in GDP, and toward business investment, the I. The theme is very clearly CapEx over consumption.
This is a major structural call they're making. The report anticipates this renewed domestic investment cycle will just favor CapEx spending across the board. And corporate guidance seems to back this up, with guidance ratios running 2-to-1 bullish for earnings.
So where is all this earning strength supposed to come from, specifically?
They see it coming from 3 main sources. First, you have AI-driven productivity gains finally starting to hit the bottom line. Second, a genuine domestic investment cycle after what they call a decade of underinvestment. And third, potential policy benefits, things like bonus depreciation that directly incentivize capital expenditure.
Okay, so if we accept that theme, CapEx over consumption, it has some pretty clear implications for sector preferences.
Right, so let's start with those consumer shifts. BofA made a pretty sharp tactical move here. They upgraded consumer staples all the way from underweight to overweight, and at the same time, they downgraded discretionary. Why that sudden defensive turn? It's really a story about a divergence in the consumer base. The middle-income cohort is getting squeezed. They're facing sustained inflation pressure in sticky services, insurance, utilities, restaurants.
Things you can't easily cut back on.
Exactly. But on the other hand, the low-income segment might actually see some relative benefits from expected Fed cuts or other policy support. So it creates this defensive tilt, favoring the staples, the necessities, over the discretionary wants.
And beyond that consumer trade, there's still overweight, some cyclicals, financials, real estate, materials, healthcare, energy. But let's get to the big one, tech. BofA warns about a potential AI air pocket. What do they mean by that?
It means that while the AI transformation is very real, the market's reaction may have gotten way ahead of the fundamentals. They do note that while today has rhymes of 2000 with the lofty multiples, today's big tech companies have much stronger fundamentals than the telecoms of that era.
But the caution is really centered on the sheer amount of capital needed for this AI build-out.
That's the core concern, capital intensity. It's a measure of how much cash these companies have to pour back into the business just to grow. Bofe points out that for the hyperscalers, capital intensity has rocketed up to 64%.
64%. Can you put that in perspective?
To put that in perspective, these supposedly asset-light tech companies are now more capital-intensive than the big oil majors used to be. For every dollar of cash they bring in, they're spending 64 cents just on infrastructure.
That's a huge structural change. So how does that end up impacting their valuation?
It creates a squeeze. The key metric Bofe points to is the spread between the return on incremental invested capital, ROIA, and the cost of that capital. Basically, are your new investments making more money than they cost? And they predict that because of high capex and rising capital costs, that spread is likely to narrow.
Which makes it harder to justify the current high multiples.
Precisely. It suggests a period where multiples might have to pause or even contract while the earnings catch up, and that is the very definition of an AI air pocket.
Okay, let's turn to the key downside risks in the report. Bofe says a credit cycle feels overdue, but it might look a little different this time because of all the private lending.
This is a critical risk they flag. The traditional credit metrics might not be telling the whole story. They say that cockroaches are emerging in private lending markets. For example, private credit default rates are around 5%, which is significantly higher than the 2.6% we see in the public high-yield market.
And why is that divergence, that gap between private and public credit, so worrying for the stock market?
Because it points to a classic and very dangerous scenario for stocks. Historically, the worst environment for equities is when you have an easy Fed, one that's cutting rates combined with tight credit conditions.
Meaning lenders are pulling back.
Exactly. Banks are tightening their standards because they're seeing defaults rise. So if public credit spreads suddenly widen to catch up with the stress we're already seeing in private markets, it could create a severe liquidity shock that just crushes stocks, even if the Fed is trying to ease.
And for investors trying to time the next downturn, Bofe has these bear market signposts. How many of those are triggered right now?
Right now, exactly 50% of them are triggered. That includes things like high valuations, elevated margin debt, and consumer confidence getting into euphoric territory. Now, 50% is still below the historical average of 70% that you see right before a peak, but it definitely tells us we're well into the late cycle stage.
We should also touch on employment risk. Bofe sees a specific risk there that could impact consumption.
Yeah, the risk isn't so much mass unemployment, it's more of a targeted disruption. The report anticipates AI will specifically reduce demand for white-collar professional service jobs.
And that's the segment that's been driving growth.
It's been the primary engine of consumption growth for the last decade. So if that high-income professional segment sees its job security or wage growth slow down, the whole consumer pillar of the economy slows right down with it.
And finally, Bofe makes a pretty strong call for institutional investors. Own public over private equity. Why are they shifting away from illiquid assets now?
The main issue is maturity risk, especially for deals that were priced during the zero interest rate period, what they call the bad vintage years. Private valuations just don't adjust in real time.
Whereas public markets have already taken their medicine.
Exactly. Public markets, especially in the value benchmark, have already been marked down by rising rates. So they offer potentially better, more realistic entry points.
This has been a very disciplined review, so let's try and synthesize Bofe's final conclusion for the listener.
I think Bofe sees 2026 as a year defined by this fundamental tug of war. You've got genuinely strong earnings driven by that capex cycle, but they're fighting against market psychology, tighter liquidity, and very extended valuations. The end result is just modest expected returns for the S&P 500. It's a market that demands a very selective stock pickers approach, not broad index bets.
And that need for selectivity leads perfectly to our final provocative thought for you to consider. Despite the dominance of mega-cap tech in 2025, the Bofe report forecasts that small-cap EPS growth for the S&P 600 is going to significantly outpace large-cap growth in 2026. The numbers are 19% versus 13%.
That's a 6-point spread. That's highly meaningful. And historically, there's a 75% correlation between accelerating small-cap earnings and small-cap outperformance.
So given that the entire macro thesis for 2026 rests on this strong U.S. capex cycle, which historically favors smaller, more domestic companies, the biggest potential opportunity might just be watching to see if small caps can finally decouple and lead the market higher. Can the fundamentals finally overwhelm the psychology? That really is the strategic question for the year ahead.
You have been listening to LR Reports. This content is for informational purposes only and does not constitute investment advice.